Well, it's time again to talk with our preferred lender, Nick Pronsky from Fairway Mortgage Company. Hello, Nick. Welcome back to the Russ Phillips team. Today, we are wanting to address timing the market issues, and there's some really, honestly, there hadn't been good news in relation to inflation and interest rates for months now. But you actually shared with me something from a gentleman named Barry Habib, a video that we want to make sure people have a chance to see and understand what else is being said out there besides the doomsday stuff that is headlining everywhere. Can you tell me a little bit, who is this Barry Habib person and why should we trust him?
Yeah, so Barry Habib, he's the owner of MBS Highway. He has won the Crystal Ball Award 3 years running for real estate and mortgage rate forecasting. So the best summary is no one makes more accurate predictions than him. And right before 2018, he said that rates would go from 4 to 5% in 2018. That's exactly what happened. And right before 2020, he predicted we'd see rates in the twos. Everyone called him crazy, and we ended up in the twos. His track record is pretty unbelievable. I get email and video updates from him daily just to keep a better eye on the market and have a better understanding of what's going on with mortgage rates. And for my money, he's the most accurate, reliable guy out there. He's really good at analyzing data and providing historical patterns and charts to predict what he thinks will happen.
Okay, so we're actually going to embed some of his commentary into this video, and we will link on our blog post and emails to where you can watch the video, the entire video. So I appreciate you putting this in front of me. Honestly, I started throwing this out to some people, and my financial planner at UBS said, oh yeah, we listened to him at UBS as well. So apparently he is very well respected. So
very much, yeah.
The first kind of thing that really caught my attention was his commentary on inflation possibly peaking sooner rather than later. Speak to that a little bit, and what should we look for in his comments here?
Yeah, I mean, he's been saying this since April, because everyone was saying, when is inflation going to peak? When is it going to peak? And he said it won't peak until October, maybe November. And he had really sound logic for it. If you look at the PCE inflation report and you look back, it's a collection of 12 monthly readings, and you add them up to get your headline inflation report. And what happened was we had really low numbers in July, August, and September of 2021. So if you take those really low numbers and replace them with really high numbers from this year, you look at record inflation. So now, if you take the numbers from 11, 10, 9 months ago, those numbers were very high. And so there's a lot of optimism that we have seen the peak of inflation, and we will start to see it come down possibly quite a bit over the next 3 to 6 months. And which is always great for us, because if you look historically at the charts, mortgage rates follow inflation. Like if inflation's up, rates are up. If inflation's down, rates are down.
All right, well, let's cut to the clip.
We can take a quick peek and we could see that the report of 6.3% year over year, which is what we're running, is truly made up of 12 individual months or 12 individual monthly components. So the reason why the bond market had an awful go in September is because the second week of September, we got that August number, and the August number was up 0.6%. It replaced August of 2021, because you only have 12 months. So as the new data comes in, it replaces now the 13-month-old data. So this change of up 0.2% being replaced by up 0.6, that made the market just puke, as we went on a year-over-year basis from 5.9% year-over-year inflation on the core CPI to 6.3%. And of course, inflation, because it erodes the buying power that you receive on your fixed payment as the recipient of that bond, it erodes it more rapidly. So the only way to get compensated for that is to charge a higher rate so you can offset the more rapid rate of erosion due to higher inflation. Well, as people are listening to this, we will have now received the report for September of 2022, which will replace September 2023. Now, we've got this rounded at 0.3%, but you can see here's the 0.3 of the line. It's really like 0.26. So the reason why that this was expected to be a turbulent time and we didn't think inflation would peak was because as the new numbers came out, they would be replacing numbers that were set at a low bar. So easy to exceed these numbers and potentially easy to see this number go up. Now, I don't know what this number is going to be released is going to be, but the chances of it being greater than 0.26 for the month of September of 2022 are probably greater than them being a lower number. So that's why we see a little bit of heartburn in this particular time frame. However, here's the good news. Starting with the October 22 report, which we'll be receiving November 10th, that is going to begin a string of reports that will be replacing much higher numbers here, as you could see. As we go into the fourth quarter of 2022, we will be replacing fourth quarter of 2021. And even in the first half of 2023, as we replace these 2022 numbers, which are higher readings, we have a really good chance to see inflation decline and decline by a significant amount. And as that happens, long-term rates, like mortgage rates, will then probably follow suit, just like they always have. I mean, you could see here, this is just a cute thing about, our Fed chair not understanding inflation, but we could see here the bottom line being the rate of inflation and this upper line being mortgage rates. Now, whether it be mortgage rates or any kind of long-term bond, that's going to be driven by inflation. So when we see inflation go up, mortgage rates go up. Inflation comes down, mortgage rates come down, and so on. It didn't follow that pattern. It was broken with quantitative easing. Once the Fed fixed the game and rigged the game, they were buying enough mortgage-backed securities and treasuries to keep yields very low. And as you can see here, the Fed did a good job, whether you want to call it a good thing or not, but they did a good job of keeping mortgage rates roughly at 3% for the QE period. But meanwhile, inflation was moving up at a pretty significant pace. Normally, mortgage rates would have gone up, but the Fed rigged the system. Notice once they took the guardrails off and let the market behave freely, mortgage rates did what they always do, move with inflation. So as inflation went up, mortgage rates went up. Inflation dipped, mortgage rates dipped. Inflation up, mortgage rates up, and so on. So as you can see, we are in a situation where as inflation goes, so will mortgage rates go. Now, there are other factors, of course, but the main driver will be inflation. And we believe that there's reason to feel pretty darn good that because of the Fed rate hikes, maybe slowing things down too much, whatever, okay? But also, we are hearing reports that the economy is showing some signs of slowing down. We know that people are having other alternatives to put money to save it instead of spend it. I mean, look at your 6-month treasury at 4%, probably go to 4.5% with the next Fed rate hike, or certainly on December 14th with the subsequent Fed rate hike. You may be somewhere close to 5%. That's going to be tempting. And remember, no state income tax on those. So that's going to be a tempting risk-free return, essentially. So people, instead of spending it, will save.
That was very enlightening from Mr. Habib. Now, I want to ask, what did he have to say about interest rates in the foreseeable future? Granted, none of us has a crystal ball, but I thought he had some really optimistic outlook. And given his status and track record at predictions, what should we look for in this next clip?
Yeah, he made a very bold prediction, a prediction that most other people would not go near that aggressive, I think. But looking back at it, what he said is that in 6 months, he expects to see rates at or below 5% on a 30-year fixed. Okay.
So you made the comment, actually, he makes the comment that you want to be the buyer on the most pessimistic day, which I'm sure people are somewhat familiar with that because Warren Buffett is famous for saying you want to buy stock when there's blood in the streets, right? Same principle. So let's hear what his predictions are and cut to Barry again.
So in terms of rates, are you willing to put a prediction out there of where you think a 30-year will be, say, 6 months from now?
I think there's a very high probability, given where the market appears to be heading. Now, look, there are things that we don't know, right? So those black swan events that could always come up. An example is unfortunate circumstance, Russia invasion of Ukraine, which did certainly throw things out of balance. We have some turbulence going on now with the Bank of England, and we know short term what they're doing, but we don't know what the long term implications as they try to stabilize that marketplace. And of course, what's happening with currencies is now also inflicting a lot of pain. You know, as we see our gasoline prices going up because of the currency carry, it is having a much more damaging effect abroad. So there are many things to consider. But given that, we think there's a high probability that mortgage rates come back below 5% within the next 6 months. Maybe an outside chance by the end of this year. But because of those inflation readings, because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, 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 lower. And as a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5, below 5 within the next 6 months. And Ed, that changes so many things.
That's a huge change.
The housing market, if I've got a 3% rate right now, I want that house, I really like it, but boy, going from 3% to 6.25%, maybe I'll stay where I am. But 3% to 4.75%, I really want that house. My family needs that. Maybe I'll go do it. So I think it changes a lot, especially for first-time home buyers too, which now can get a rate that's easier to obtain. That purchase of a home.
Well, that was all very interesting. So now we're sort of faced with, if I'm a buyer and I know I need to buy in the next few months or the next year or so, I'm thinking about, how do I time the market? How do I process all this? Well, of course, let's get the elephant out of the room. Realtors have said for years, oh, it's a great time to buy. It's the perfect time to buy. Oh, you need to buy because of interest rates, right? So, let's just kind of lay that aside, because honestly, the Russ Phillips team always wants to do what's right for our clients. But when it comes to timing the market, you had some really interesting thoughts to share based upon some of your data gathering. Share that with us.
The way I look at it, you have someone like Barry Habib here predicting we might see 5% rates in as little as 6 months. And then you have the head of the Mortgage Bankers Association predicting that rates will be at 5.4 next year and 4.5 the year after. So obviously these are all predictions. No one knows the timing of it. No one can guess that with certainty. But what I do know is there's a lot of people sitting on the sidelines right now waiting for rates to drop, for prices to do something, whatever that may be, and they're trying to time the market. And I think we all know from experience that it's an impossible task. And what's going to happen, I think, to a lot of people is that they are going to try to time the market and they're going to wait until rates hit a certain point. But the problem is so many other people are doing the exact same thing, where you have a huge amount of pent up demand. And so by the time rates do drop, everyone is going to be jumping back in the market. And we're going to be right back into the same situation where we have competitive offers, too much demand, not enough supply, and all the deals that people are getting on houses right now, that will be a thing of the past, because we'll be right back into more of a seller's market. Whereas right now, we're seeing some pretty incredible deals for buyers out there. We're seeing discounted prices, seller paid closing costs that are significantly higher than what we've seen. So there's a good chance that those people who time the market might look back and say, wow, I wish I would have bought the home at a discount in the fourth quarter of 22 or the first quarter of 23 when I had a chance. And then because those people that buy now can still refinance later when these rates go down, but they might not be able to get as good of a deal on the house.
And so let's touch base on that again. There's a lot of talk about 2-1 buy downs in the current market, and a lot of people are expecting sellers to pay the upfront loan charges for that. So for those that don't understand, a 2-1 buy down, basically, if you're looking at a 7% interest rate, the first year you get 2 points less for your monthly payments. Then the second year you get 1 point less, and then the third year you would hit 7%. If all this crystal ball that we're talking about plays out, you would have ample opportunity to refinance at a much lower rate before you ever get to that 7%. And what's even cooler about it is, let's say you refi in a year. Nick, you've helped me understand that in a 2-1 buy down, the seller is actually prepaying the difference in payments. So if I'm paying a 5% payment, he's paying the spread between that and what I would have paid at 7%. All up front at closing. So if I refi before that 2-1 time frame expires, I actually get a refund from what the seller paid at closing. So I really maximize the incentive that was given to me in the negotiations. That's amazing.
Yeah, that's exactly right. It's guaranteed money in your pocket one way or another, whether it's two years of monthly savings, or if you refinance before it, it'll be given to you in a principal reduction to lower your loan amount.
Right. So to sum up, it is no hard thing to find doomsday headlines and statistics and numbers. Clearly, sellers have gotten way more humble than they were even 6 months ago. So from a buyer's perspective, this is a time of opportunity where they're going to be a lot more lenient. You're not rushed. It's not a multiple offer above list environment like it was. And there's a good chance that in a year, 18 months, something like that, if this pans out, you could be patting yourself on the back and telling your friends how smart you were by actually timing the market. Now, this is not an endorsement of trying to time the market. This is just insight that we are giving, that we from data that we've collected from people that are knowledgeable, rather than just the Chicken Littles who are saying the sky is falling. So nobody has that crystal ball. Any last thoughts, Nick?
Not at this time. I mean, I think we covered a lot out there, like exactly what you said. I mean, I think right now is important to just look at the data out there and educate yourself on that without just looking at news headlines, because most of that seems to be pretty designed to strike fear in people, and there's been a lot of inaction as a result. But if you really look at the charts, the historical patterns, there's very sound logic, and history doesn't repeat itself, but it tends to rhyme. So you can pick up a lot from studying those patterns. Great.
How do we get in touch with you if we have questions?
You can always call me on my cell phone. It's 512-709-4372, or you can just go to nickpronsky.com. It's got all my contact information there. I'd be happy to answer any questions for anyone out there.
Outstanding. Nick, I appreciate you keeping a watchful eye on these things for us.
Thanks for having me.